Hey there, everybody. Happy Tuesday, April 22nd, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny, kind of comfortable Redmond, Washington. There's sunshine outside. There's sunshine in the markets with the S&P and the NASDAQ having nice upside reversal days after a rough start to the week Monday. Yesterday on the show, we talked about that last hour of trading with the upsurge. Almost felt like it just continued out of the open today, continuing to push to the upside. Now, what we haven't had yet are a bunch of earnings really starting to come in, some before the open, and some interesting ones like a Pulte Homes we'll take a look at. First Solar with a nice bounce today. The real exciting stuff is coming after the close here. Tesla reporting did not look like a good report as I glanced briefly, and that's started a minute or two late. I was going through a flurry of earnings headlines to sort of digest what all is going on. While on major media, financial media, they've got whole teams of analysts and reporters covering every stock and highlighting important things. I'm looking at the headlines myself and seeing what I can parse through between the close and the show. Having said that, though, we'll continue to react as best as we can to all of the flurry of earnings coming out here after the close. But however you want to decide, you want to describe today. Yesterday, a big down day with very negative breadth. Today, a big up day with very positive breadth. We'll look at how things changed from yesterday to today. We'll talk about what today's move means. Honestly, when you look at a lot of the charts, they haven't changed a ton. Even with the nice rally today, we have to remember that this is a noisy market with a lot of volatility, which means regardless of the long-term direction, you're going to have big down moves and big up moves. I think now more than ever, you follow the market maxim, or certainly the technical analysis maxim. When in doubt, zoom out. So we'll do our best to zoom out a little bit, try to provide some context for everything that we're seeing and hearing. And let's get to the market recap. So let's look at the numbers and see how things played out. We'll look at the market carpet. You'll see a lot of green today, so a nice contrast to yesterday's bright red heat map. And then we'll look at the charts, focus on a lot of individual stocks today because we got a lot of things moving quite a bit. The S&P up about 2.5% today. That's 5288. The NASDAQ Composite up 2.7% to 16,300. Mid caps, small caps, all up. No real theme there between large, mid, and small, all kind of to the upside. The VIX moving lower, still elevated, right? So the VIX is down about 3 points to 30.5. We've talked a lot about the VIX recently. Actually, yesterday on the show, we looked at the VIX of the VIX, which is $VVIX, pretty high. And what that means is the movements in this market is extreme. The VIX up around 30 basically means the market is pricing in multiple percent moves in the major averages on an average day, which means what we're seeing today, while it feels crazy unusual, is pretty much what the VIX is telling you is very usual for right about now, right? Expectations are for big price swings. We are certainly getting that. The injection of headline risk has created volatility. Earnings is going to have additional volatility as well. It's a maelstrom of market movements right about now. All right, let's keep going. Look at the other asset classes, and we'll continue on. Bond markets overall kind of mixed, to be honest with you. The TLT was down about 0.5%. That's a Treasury, sort of long duration Treasury ETF. You can see that the 5-year points slightly higher, 10 and 30-year points slightly lower. One of the charts I was looking at earlier, I don't think I grabbed this for the chart review, but I was looking at the trend in the yield curve. And basically, if you look at the 2 to 10-year spread, which is the most commonly referred to over my career for sure, continuing to increase, meaning that the slope is increasing, meaning that the yield curve as measured by those 2 points is steepening. And that's usually a good thing. Now it's being driven right now because bond prices are coming down generally overall. And so that's what's creating this steepness of it. But usually as that yield curve gets more steep, more of a normal shape, that implies long-term economic optimism. That's usually during a recessionary period. You kind of have an inverted yield curve. You get in a recession, that eventually the yield curve kind of normalizes itself, and that gives you an opportunity to sort of change and expect more economic growth over the long term. It's kind of an encouraging thing as you see the yield curve continue to normalize. So we'll take it. Dollar index up a bit today, and that's another one, right? So the general trend has been weaker dollar, weaker stocks, weaker bonds, all of that reversing today. So you're seeing an upside move in bond prices, upside move in stocks, of course, and an upside tick in the dollar. Looking at the commodity side, gold and silver, two of the strongest charts we've been highlighting, making a new all-time high yesterday, coming off of it today. The GLD was down about 1.4%. Silver prices down about 1%. Copper did move higher, and crude oil prices did move higher as well. Speaking of crude oil, I have a chart I'll show you a little later. I think I grabbed LNG, but I forget which one, which energy stock that I grabbed. Interviewed Rob Thummel, who's a portfolio manager at Tortoise Capital. They run a bunch of energy-related mutual funds, ETFs, and closed-end funds, other products. Really awesome interview, really fascinating. I asked him as many questions as I could just about the structure of the energy industry, U.S. energy independence, geopolitical issues, valuations in energy stocks, the AI opportunity for demand for energy and for electricity. Really good interview. It's not quite ready yet. We'll have it out for you later tonight, maybe tomorrow morning. But make sure you check out the latest episode of the Market Misbehavior podcast. It's going to be an all energy discussion. It was actually really, really interesting. I learned quite a bit just from asking those questions. Cryptocurrencies continuing to push to the upside. Talk about a market or an asset class that is completely ignoring what's going on with the equity markets and just sort of going full risk on. Bitcoin and Ethereum are it. Bitcoin up another 4% today. We're above 91,000 as we go live with the show. Ethereum price is just above 1,700. That's up almost 8% from yesterday's close. And you can see the rest of the top 10 coins here on the stock charts platform, all in the green. All right, looking at the sectors, all good, right? So green across the board. Financials at the top of the list. And I say it with a little bit of disbelief because I can't remember the last time that financials have been on the top. The XLF up about 3.3%. Now, before you get too excited, you have to remember that the strongest technical configurations in the financial sector, it's not the big banks. It's not like JP Morgan and Goldman and Morgan Stanley are particularly great charts. It's all the other stuff. It's like all the things that aren't banks that tend to have the stronger charts. Insurance companies, exchanges, market data providers, like the sort of the other financial names. Berkshire Hathaway, the biggest name in the XLF, and one of the better charts. Those are the ones really doing well. But the other those other things, the banks, are bouncing off of their recent lows, and as a result, the sector as a whole doing pretty good today. I did grab the chart of the XLF. We'll look at that a little later today. The XLY consumer discretionary also up 3.2%. Now you had some nice rallies in some of those big consumer names. Tesla reporting after the close today. We'll do a little post-market after hours check as we get into their earnings call. But Tesla having a nice rally going into today's report. Utilities number 3 up 2.7%. Worst performing sector, consumer staples, still up almost 1.5%. The XLP was up 1.4%. Industrials and healthcare both up about 1.8% for the day today. So again, looking at today's price action in a vacuum, pretty strong day across the board, right? Offense over defense generally, getting a bit of a risk on move. I think the rally of cryptocurrencies all encouraging. The breadth, pretty solid, right? Yesterday, we're talking about 90% down days. Today, 98% of the S&P moving higher, 91% of New York Stock Exchange listings moving higher. I feel like the VIX, if there was a VIX for advancers, decliners, a breadth VIX, if you will, it would be pretty elevated here as well. I mean, and this is, I think, the challenge right now is if you have like 2024 on your brain, kind of that low volatility uptrend. If you followed our shows during that period, I mean, it was sort of a broken record of low volatility upswing, things kind of working. Most things are going up. We're above moving averages, sort of this nice, slow and steady thing. And you didn't have a lot of 98% up days just because most things were going up, but some things were kind of not working. Now you're actually getting all this volatility. So one day to the next, everything's up, everything's down. It's more of a macro environment, right? I mean, there's some stocks doing stock specific thing, but I think, right about now, it's more, broad movements, broad risk on, risk off. I'm not thrilled to see the Keller market model widget flashing all red on the front page here. Now, this is a placeholder after yesterday's close. It's not updated for today's close. The long-term model actually did turn back above zero as of today's close. That's just a placeholder during the week. At the end of the week, after Friday's close, is when I formally make any changes. But after yesterday's pullback, all across the board, the market trend models are down. That tells you what the potential is this week. I think that tells you why this week is so important in terms of my assessment of the long-term trends, because we're very close to seeing a confirmation of a long-term bear market phase. We'll see what happens. Obviously, a lot of game left between right now and Friday's close. Looking at the Magnificent Seven and Friends, these leading growth names, you can see Netflix reporting earnings last week. By far the strongest of this basket of 8 stocks, not even a competition, up another 5.3%, powering above that 1,000 level. That's a big round number that we talked about, whether it would be able to break above there. Certainly possible. Tesla, number 2, up 4.6%. Now, don't get too excited because earnings coming after the bell today. We'll see what actually happened and how the market's trade or how Tesla's trading in the after hours. But important to note, is up almost 5% going into today's report. Amazon, number 3, up 3.5%. So the consumer discretionary sector doing quite well if Amazon's up there at 3.5% for sure. And then Tesla, of course, one of the 3 top weights as well. Worst performers out of this: Broadcom, Nvidia, Microsoft, the big technology components in the Magnificent Seven, outside of Apple, which had a nice update today. But those stocks that were the worst performers were still up about 2%. So certainly risk on. The Mag 7 names doing well. I mean, things pretty decent if you look at today's session here. Let's look at the market carpet. And this is a heat map style visualization. As we bring this up, I do see questions and comments coming in from YouTube, Facebook, LinkedIn, and X. And I see that comment: if market keeps going down, we'll blame Keller. No, you don't. I wish I had that much power. I really don't. As much as you might want me to. I'm an observer as much as anyone else. But I can't see the questions and comments you're putting in on any of those platforms. Thanks so much for making the session interactive. We'll get to a couple questions at the end of the broadcast. Anything we don't get to, we'll put in the mailbag. We've had a lot of fun with those Friday mailbag episodes and expect another one this coming Friday. We'd love to answer one of your questions on the air on Friday. All right. Looking at the heat map. So on a day like this, when kind of everything's up, anything that was not up stands out pretty well, right? So anything that was flat is going to be that amber color. Anything that was down is going to be in the red color. And there's only a handful of stocks that were actually legitimately down today. 2 of those big defense names. So while some of the earnings was pretty encouraging here, not everything. And Raytheon and Northrop Grumman taking it pretty hard today. NOC is a tough chart. I actually grabbed both of those charts so we can look at them independently, but both of these down pretty big today. Northrop Grumman down almost 13%. That's coming off of an attempt to make a new all-time high this week. Raytheon down almost 10%. Now, Raytheon did make a lower high and was actually pushing back up around 128 going into today's session. But today making a new 3-month low with today's sell-off. So defense names kind of taking it pretty bad. Now that's an interesting one because defense stocks have been doing very well given the geopolitical uncertainty, given the idea of European nations investing a lot more in defense, all of those sorts of things. I think this is a tariff issue as certainly as part of that, with some of these companies, reporting higher costs, et cetera, related to potential tariff pressures. Most of energy stocks did actually pretty well today, but Halliburton was a notable outlier, down about 5.6%. In the materials sector, Newmont, there aren't many gold stocks or mining stocks in the S&P. You've got Freeport-McMoRan and FCX, which is more of a copper miner, and then Newmont, which is a gold miner. Newmont was down 1.2%. It's not that bad of a day, but these are stocks, and certainly spot gold has been on an absolute tear recently. And then Kimberly-Clark, KMB, in the consumer staples sector. So most of consumer staples actually did okay today. but you can see KMB in particular down a bit. We'll see what happens as we start to digest earnings today and then continue to go on through the course of this week. A lot more earnings every day as we go on. So again, looking at the heat map, I mean, this is what our life is going to be like, at least for the foreseeable future. One day where everything's down, the next day where everything's up. Big swings, big volatility. The market and certainly the elevated VIX tells you this is the norm now. This is what we should be prepared for. And so again, I would say now more than ever, it's so important to not draw long-term conclusions from short-term data. I always tell people, draw short-term conclusions from short-term data, draw long-term conclusions from long-term data. So don't see a day like this and say that this heat map tells us we should be bullish overall, like on a longer-term time frame. This tells you one day was pretty positive, no denying that. Does that tell you the trend has necessarily changed on some of these charts that are still in downtrends? I would argue no. Series of days like this that form a trend that cause a change in trend and a change in momentum, 100% true. Speaking of which, Gary Antonacci, author of Dual Momentum Investing, one of my favorite books on dual momentum. I just emailed him earlier today. We're locking in a date to interview him on the podcast here in the next couple weeks. That should be a really good one. He literally wrote the book on momentum investing that I have on my recommended reading list, which you can check out on my website if you like. But we'll have him on the podcast here very soon as well. All right, I think that's enough. Nice day. After yesterday's down day, I'll take a day like that looking at the heat map. All right, as we get into the charts, as a reminder, free webcast coming up tomorrow on Wednesday, April 23rd, 1 p.m. Eastern, 10 a.m. Pacific. I will be presenting a free session called The 4 Deadly Sins for Investors. This was a presentation I did at the Money Show earlier this year in Las Vegas. Hopefully met some of you there. A number of people there mentioned that they watched the show. So if you're watching, hello again, and thanks for watching. Those of you that couldn't make it to that session, I hope you can enjoy this webcast. We'll talk about how we tend to buy too late, sell too early, all of those kind of mistakes that we make. I'll call them the 4 deadly sins. I'll share with you why we have a tendency to do each of these mistakes, what is happening between our ears, and what we can do about it, how we can use technical analysis specifically to address each of those sins. You can sign up using the QR code that you see on your screen, or go to marketmisbehavior.com/April. If you can't make the session live, just make sure you sign up, and I'll make sure I send out the replay as soon as it's available. All right, continuing on here, looking at the daily chart of the S&P 500. So again, I mean, nice update today. What's interesting today, looking at the bounces, yesterday's low was right at 5,100. I still have a horizontal line going back from the August 2024 low. That's what that level was. And that was the beginning of the Fibonacci analysis that we've used. That's been quite helpful through the course of the year, really helped us identify that March low. And I think the break below 5,500 was pretty transformative in terms of validating the downtrend phase that I think we're still sort of in the midst of. Drawing trend lines, we're still below most trend lines that I would draw on this chart at the moment. I think the momentum is still weaker than I would want to see. So, again, things that would make me be less negative about this chart, confirming that this was a higher low at 5,100 with further upside, that would certainly help. The bull case from here certainly means we break above this purple trend line, which are the major highs in 2025. We break above 5,500, which gets us sort of back into that Fibonacci framework that we talked about earlier in the year. All of those would be pretty encouraging. Also, the momentum improving, right? The RSI is still kind of below 50, right? So we can have up days with the RSI below 50, but until that changes, right? Until you see stronger momentum, not just on one day, but building pressure, right? That's when I think you have an exit from this sort of choppy, noisy April of 2025. I mean, certainly one of the noisiest months that I remember in recent history. And again, I think what you have to do is just sort of take a step back, try to get away from the day-to-day fluctuations, and just think about what momentum shifts you're seeing, right? What relative strength is improving or weakening, where momentum is starting to improve or come back. While I'm seeing a lot of fluctuations day in, day out, I'm not seeing a lot of trend changes just yet. But we'll see, right? And again, I think earnings this week is going to give us plenty more reasons why stocks and certainly the indexes can and most likely will continue to fluctuate. Now, Bitcoin really exiting out of a consolidation range in a pretty bullish way, I would say. Bitcoin currently around 91,200 here after 5 p.m. Eastern on Tuesday, the 22nd. That breakout takes us above 88,000, which basically clears the 200-day moving average, also clears those March swing highs. We talked about this on yesterday's show, that potential to break out here. I think what we're seeing now is a valid breakout. You look for follow-through, right? So you want to see an additional move in that same direction. But I would say overall, Bitcoin in a constructive pattern. This is what I was talking about with the S&P, right? If you look at the chart of Bitcoin, not too dissimilar from what we're seeing with the S&P, coming off of the peak. In this case, in January, you saw the RSI kind of gets low and stays low, like remains below 50 all through February, all through March, through the first couple weeks in April. Then all of a sudden, we're just starting to break higher. And this week, we're finally getting RSI pushing above 60 again. And that's what a buying pressure, buying power, signs of accumulation. That's one of the things that I would look for. A breakout on stronger momentum, suggesting or certainly implying that buyers are coming in and pushing prices higher. So that's what I'm not seeing on the chart of the S&P. That's why I'm less constructive on the S&P at this particular time, and certainly more optimistic on what I'm seeing on the chart of Bitcoin, starting to break out of that clear consolidation phase. I think there's more upside to be had there. Based on the trends. All right, the rest of the chart review, let's talk about some individual names. Some of these are just big names that I think are important to understand and to track. Others are earnings names, and I'll try to highlight key takeaways when we can. And again, the chart of NVIDIA, I mean, it's just still not a good chart, right? And so that's what I remember when I see a big update like this, when I see the benchmarks higher. It's like you have to take a deep breath and just look at some of these charts and say, all right, is the chart of NVIDIA a good chart? I would argue no, right? If you zoom out a bit, you see besides these noisy periods, and this was up 2% today, it's still a pattern of lower highs and lower lows. The momentum is still negative. The relative strength is still weak. So, mega cap, leadership names, previous leadership names like an NVIDIA, still not enough to change. And I think the most recent kind of short-term tactical signal we saw was this gap lower from what was that, like April 15th-ish, I think, down to gapping down there. And opening around 10, just below 105. So until we can even get back to that gap range, I mean, this is still a tactical downtrend over the last week or so. So again, I think there's more to prove on a chart like that before it looks constructive. One Magnificent Seven name that I think has very little to prove anymore is Netflix, and we've highlighted how that is a differentiator. It's a good reminder that too often I feel like we try to simplify by grouping like the Magnificent Seven as one basket. And I think hopefully what I've tried to do is show you how names like Tesla have been outliers, names like Netflix now have been outliers to the upside. And if the chart's a good chart, then it's worthy of your attention and maybe worthy of your capital. But if it's not a good chart, I would avoid it, right? And so what makes Netflix a good chart here? The fact that the relative strength is making a new 12-month high, that's a decent start. The RSI pushing above 50, pushing above 60, which indicates strong positive momentum. Instead of stalling out at the late March peak, we're actually powering above there. That's also a big round number of 1,000. So now we're facing previous all-time highs from the mid-February peak. So think about this, right? Netflix is testing its all-time high from earlier this year. Very few S&P 500 members are in a similar condition, and that alone is what's certainly helping the relative strength to improve to the degree that we're observing. So I think Netflix is a good chart. I don't own Netflix directly. I'm certainly through ETFs that I own have a decent amount of Netflix exposure, I would imagine, but good chart and a good place to be, I would argue. Right, compare that to what you're seeing with the chart of Apple. Now, I've drawn some trend lines just sort of tracking this downtrend phase. Apple, compared to the S&P, which actually made a new high in February, Apple's peak comes around Christmas, right, of last year, right, end of December, and then January starts, and we begin this sort of choppy downward trajectory that really accelerated in the month of March and continuing in April, right? The gap lower in early April, we rallied up and basically stalled out in that gap range. I don't have the gap highlighted here, but I probably should. That's something I would pay attention to. Now what's interesting is in the short term, it's kind of a question mark, right? Maybe we made a higher low yesterday. This is what we see like on the chart of the S&P. This is called a dragonfly doji candle. If you really want to know your candle patterns, that's one to lock away in your brain somewhere. It's where the open and close are almost identical. Minimal upper shadow, long lower shadow, kind of like a hammer candle, but the open and close are almost identical. It's called the dragonfly doji candle. So we gapped higher today, which actually is pretty common after you have that particular candle pattern. Next 1 to 3 bars are higher. But again, I'd love to see us get above trend lines here, right? I mean, what's the problem with the chart of Apple? You've had a number of nice bounces off of a new swing low, but not enough to get above like trend line resistance, not enough to get anywhere near moving averages, which are well above current levels, and not enough to make the momentum more positive. So again, despite these bounces we're seeing this week, and Apple up 3.4%, that's a nice day. But is the trend a good trend yet? And I would argue still not, right? Weak momentum is weaker than you'd need to see. Trend lines are still holding, right? I think you get interested, at least I would get interested when we break above trend line resistance. And that's what we're not yet seeing with something like Apple. All right, we come to Tesla. Tesla, a decent day, one of the best performers in this basket of mega cap growth names. Bouncing off 220 was pretty important. That happened, from the early March low. We tested that again in mid-March, again in early April, and now again, this week we're testing that 220 level. So, I mean, from a technical perspective, I think we're sort of in that no man's land, in limbo between 220 as key support, between 290, we'll call it, as key resistance. That's the 200-day, and that's also the late March swing high. So at some point we break out of that range. I would guess that whichever way we break, that's the new direction of momentum, and you want to kind of follow it. Now, they did report after the close today, bouncing up a bit. So when I checked earlier, it was kind of flat. What's interesting is the headlines I looked at, not a great quarter, but stock bouncing in the after hours. That's encouraging. We'll dig into their earnings call when I have a chance to do so later, and see what's been said. But it's currently trading around 245, which is, I mean, that's not a big up move. That's kind of right up here, right? I mean, that's just above today's, right around today's high, to be honest with you. So still kind of within that range here, pushing up a little bit, which could be encouraging. And as long as 220 holds, that's not a bad, I mean, that's not a horrible chart. It's not a great chart, right? And the things that we talked about with improved momentum, breaking out, all of those sorts of things are what we would need to see. You can also draw a trend line on the chart of Tesla. It's kind of up here somewhere by these moving averages. I mean, so that's the kind of follow through I would want to see. Let's see how we open tomorrow if we do get an upside reaction after today's earnings. Now, a couple things gapping down big time today on earnings. NOC and RTX are two of the defense stocks. We've highlighted some of these because they've had some pretty decent charts. Now, NOC has been a really good rally off of the February low, and it outperformed beautifully over the last 2 months because the market, the S&P, topped out in February and rolled over. This stock actually bottomed out in February and rolled higher, and we've accelerated higher after a pullback in early April around the tariff, the beginning of the tariff stuff happening, continuing to threaten new all-time highs, and this week reapproaching that high from fall of last year of 2024, that late September, early 24 peak. Now we're seeing the gap lower today on the earnings miss, down about 13%. It was a choppy session, but overall gapping below the 200-day moving average, which means at least I'd want to see a bounce back above the 200-day for any sort of optimism. Here you have Raytheon gapping down back to the previous lows, and that's kind of an interesting one. Same thing. These two names were down together alongside the other defense stocks. You can see the gap lower. It takes us right to the low from earlier April. That was the low in the days after the initial tariff announcement. So now we basically round trip back to those lows. That also lines up really well with the January 25 low. All of that's right around 113, 112 to 113. So again, anything below what I'm seeing right now, and that's a pretty ugly chart with a breakdown that I would personally be avoiding. We'll see if it's able to hold support again through in the days to come. All right, the XLF, the financial sector, I just want to highlight, this is the top performing sector today. The XLF was up 3.3%. You can see the XLF getting back to 47. I have this horizontal line just to show what we would call a pivot point. A pivot point is a price level that has meaning on a chart, is how I would describe it. Anytime you can draw a horizontal line where a bunch of highs and lows kind of line up at that point, it just tells you that's an important level for the chart. Now, what's happened is the XLF got down to just above 42 after the initial tariff announcements. We've come back up to around 47, almost 48. Now we're settling right into that 200-day moving average. So I think the test now is, can we get above the 200-day and hold it? That would also get us back above 47. That's why that level is so important. I think anything above there is pretty encouraging. Anything below there, and this looks like a broken chart, getting worse. Now, the good news is, even though it's testing resistance, the relative strength is so impressive, right? Look at the last 8 to 10 months, great relative performance. Now, it's not driven primarily by the banks or the regional banks. It's driven by the other stuff. And have one of those as an example. Here's what the chart of CME Group looks like. Now, I mean, if I ask you, name a bunch of stocks off the top of your head that are above upward sloping 50 and 200-day moving averages, the only ones you're probably going to come up with, if you've watched my show, are probably ones that I've shown, because there aren't many on there. I mean, there's a handful of names. That's not true. They're probably 80 some, but not a ton, right? Not as much as you saw in previous bull market cycles. So CME Group actually holding up beautifully, right? Above the 50-day moving average. The 50 is above the 200 days. Is one of those stocks where the moving averages are in the proper order, as we call it, where you see this nice sequential order of short-term to long-term moving averages. In this kind of environment, these charts are very rare, but very encouraging. And being in names like this, I think, makes a ton of sense from a technical perspective, because just being in an uptrend of any sort allows you to outperform, because most things are not in an uptrend right about now. The kicker for the financial sector is not whether CME Group continues to look good, although that's not going to hurt. It's these other names, right? The market cap is really in the bigger banks, things like Goldman Sachs, JP Morgan, Morgan Stanley, money managers like Schwab and others. This is where more of the market cap is. And you see that on a day like today, Goldman Sachs is up about 3.7%. And while the chart of Goldman Sachs, I would say, is still underwhelming, similar to like the S&P, I think there's more to prove. Similar to the chart of Apple, I think this is a stock below the 200-day, below a clear trend line. I get excited when that changes, right? When we see positive momentum, breakouts, and follow through. And none of that we've seen yet with Goldman Sachs. But there's enough of a rally off these lows, combined with some of those charts like Berkshire and CME and others doing well, that's allowing the financial sector to be a pretty decent place to be for now. The relative strength is what's most encouraging, and I think that's is something to watch. McDonald's, another chart I wanted to highlight today, up about 3.3%. Again, there are not many names that are actively testing their previous all-time highs. We showed Netflix earlier. I'll show you McDonald's here. Not a bad chart. And again, a not too bad chart is an amazing chart relative to the average chart in April of 2025. And you can tell that by the fact that it's kind of testing resistance, trying to break out, but the relative strength is going consistently higher. And I think that's what draws me to a name like MCD, is the fact that it gives you an opportunity to outperform. I mentioned my interview with Rob Thummel. Again, look for that on the Market Misbehavior podcast today. Maybe tomorrow morning we'll get that released to all of you. Really good deep dive into the energy sector, hitting on some themes that I'd been thinking about and curious about, and a lot of fun to ask an expert about them. LNG, Cheniere Energy, was one of the names that we talked about. Talked a lot about natural gas, about pipelines, infrastructure, and LNG was one natural gas that certainly came out. From a technical perspective, again, good chart on a relative basis because it's not breaking down. Really close to resistance around 235. That's after bouncing off of the 200-day moving average. So it may be an interesting setup if we can get above 235. But again, on a relative basis, pretty encouraging. Some of the biggest bouncers today were ones that were down quite a bit. FSLR is a renewable energy name. This is a solar name. Broke briefly above the 50-day, although it closed below it. Broke briefly above 140, although it didn't close above there. This is a name I'm watching actively to see if we get a break above resistance, to see if the RSI can push above 50, ideally above 60. This came on our radar because of the bullish momentum divergence, lower lows March and April, higher lows March and April. Is that the follow through? Very, very close to a tactical breakout. That could be an interesting opportunity. The risk reward is obviously pretty compelling with very little space down to the previous lows, but plenty of upside to the 200-day moving average. Could be an interesting new breakout name to watch. And also home builders, PHM, reported earnings before the open today, up about 8.4% today. Now, I would argue still in a downtrend of lower highs and lower lows. We're still below a downward sloping 50-day moving average, but that 50-day is getting a lot closer with today's 8% gain. I'm watching that one to see if we get a break above the 50-day. A break above trendline resistance could be a really interesting opportunity to get into home builders, which have been pretty underwhelming from a technical perspective. All right, let's get to a question or two, and then we will be done for the day. YM, thanks for watching on YouTube. U.S. equity futures up big on Trump saying he won't fire Jay Powell. How do you TA these news daily? Boy, I mean, I'm not surprised. I mean, see, if the market's up after the hour, I mean, the headline risk that you have in this environment is just excessive. And and again, how do you do anything in this environment is I guess the real question, right? I don't think this is a technical analysis specific issue. I think this is a reality. And again, when the VIX is high, it means the market is expecting big swings, and that's what we're getting. So I think this is pretty much on there. And I've seen a couple other questions talking about that. I mean, the challenge with this market is the fact that you have, I mean, to be honest, you have someone with a megaphone that everyone's listening to that has big market moving potential. And that means day to day, we're going to get big upswings and big downswings. For what, I do and my peers in the financial industry whose job it is to be strategists and think about, look down the road and think about where are things trading today versus where we think they could be trading down the road. All of this headline risk does not make that task more easy. And I would say whether a fundamental analyst looking at, quarterly statements, that doesn't help you manage this headline risk. If you're a quantitative analyst running an alpha model, this is making absolute haywire messes of any model you have because your model probably didn't price in this sort of movement day to day. And so it's going to be tripping things very, very quickly. So volatility makes a lot of things pretty challenging. And again, I mean, if there's, what I would say is the way you navigate this gets to another question, which I'll show here briefly, and then I'll give you my answer because I thought this was a great one. My name is Chuck. Hey, Dave, how are you dealing with the psychology of the deflating market? It's so depressing. I love the honesty and the genuine nature of your question, and I hear you. So what do you do in this environment? So number one, I would say, remember, short-term movements are short-term movements. Take a deep breath, take a step back, look at longer-term trends. Ask the question, did anything really change? I think the biggest challenge we have is the headlines are all comments. It's all conjecture. It's all statements. Dramatic changes in policy are being added and then withdrawn, are being implied, but then completely erased within a 24-hour period. This whole thing about Powell's going to get fired. No, he's definitely not. I don't know where you got that from kind of headlines. That means markets are going to move, right? So I think the volatility is real and is going to be sustained because of that. The bad news is I don't see that changing here for a while, right? This is our lot in life in the U.S. With the U.S. Political current configuration. So I think that's just something we have to brace for. So from a technical perspective, what do you do? I think this makes a lot of things very, very difficult. I think the best things you can do is take a step back, look more at longer term shifts, make sure you're positioning yourself for longer term rotations. And again, the good thing about volatility, it makes swing trading more of an opportunity, right? So I mean, dialing in your time frame a bit with part of your portfolio and just betting on movements, it can be very, very helpful. It's not something I'm choosing to do with my portfolio, but I don't blame you for trying to do that. What else do you do? I mean, I would say the other thing is, as always for me, I go back to mindfulness. I go back to mindful practices, meditation, and things like that to keep centered. And I would say for me, the biggest thing that's helped me through a period like this, when I've seen volatility before, is the weekly and monthly routine. Day to day, things get a lot more crazy. Movements get a lot more exaggerated. So it's easy to get really stressed out about big swings up and down. The weekly routine, which is the markets are closed, the markets are not moving. Okay, what really changed from last Friday to this Friday? This is why my market trend model updates every Friday after the close, because everything between Friday 4 p.m. and Friday 4 p.m. the next week is noise, and then we sort of evaluate where things are at. So lean into your routines and as much as possible, focus on the evidence. I don't think, having gone through a lot of cycles being a momentum investor, this doesn't mean momentum doesn't work. It just means it looks different than it did last year. I think the basic premises of finding what's working, finding what's not working, make sure you own more of the former and less of the latter. That's still going to work. It's just going to create a lot of noise from one day to the next. So stay centered, stay focused, stay long term. Take a deep breath. When in doubt, zoom out. Those are all things that I think would help quite a bit. And if it helps you at all, I would say, talking to a lot of my peers in the industry, we're all looking at each other like, "Wow, this is really crazy, isn't it?" And it definitely is. All right, maybe one more question, and then we'll be done. Richard, thanks for watching on YouTube. Is it true that there could be no bull market without financials? That is so yes and no, right? So that is something that has been thrown around for a long time, and it comes from a good place, right? I mean, generally that's been true. The financial sector tends to be a pretty good indicator of sorry, I just read a beer every red day. Thank you for the constructive suggestion there. And I appreciate it. I'm going to show you here the rotation. Where am I looking? Sector, not the sector drill down, sector perf chart. Here we go. So this is basically, this is where that comes from, right? This is the sector rotation model. Sam Stovall I actually just had on my podcast last week. Check that one out. That was a really good conversation. Smart guy, great experience in the markets. And this simple visualization is inspired by Sam's work looking at cyclical patterns in the business cycle and in the market cycle. So in orange, you kind of have the idealized market cycle from a bull market phase to a top to a bear market phase to a major bottom. And if you look, these are the sectors that tend to do well in those different market regimes. At the end of a drop in markets, one of the early places where you find leadership is usually financials. And then once things get started, you start to see growth sectors like technology and consumer discretionary take in. But financials are one of those good, like, early leaders. When the markets are in a recession, when things are getting pretty bad and outlooks are brought down, you look for financials as early leadership. So, strong performance in financials could be a great sign, not just for the financial sector, but for a potential recovery from whatever it is that we're experiencing here. And if you think about it, there's a lot of reasons why that is, right? The yield curve is part of that. So you pretty much, as things start to improve, you start to get the yield curve starting to rotate. We have like the peak and then the falling in the curve. The steepening of the curve is much better for banks and financials companies, and so that optimism leads to additional borrowing, and then people are spending more, and all of that is helping the financial sector. So that's why it's one of those things. Having said that, there are plenty of times where it hasn't worked out particularly well. I mean, coming out of the financial crisis is one of those. The XLF spiked, and I'm paraphrasing this because I don't want to bring up the chart, but I think the market bottomed in like March of 2009. April, May, I remember financials just leading, like the bottom popped right up. Bank of America just spiking higher. But from then on, they were laggards for the whole rest of that recovery in 2010 and beyond for a while. So they kind of spiked early, but then, really were laggards. So not always. The market can rally without financials. And that's why I think waiting for financials because we need it, I don't think that's the way to do it. Betting on financials when the charts tell you to do so, that makes sense for me. All right, guys, thank you guys so much for watching. I appreciate the thoughtful question. I see a lot more coming on. I will put any question we don't get to into the mailbag, and we'll do an all mailbag episode on Friday. The movements you're seeing today are going to be the norm and not the exception. We're here along with you to navigate, to try to translate, to help you understand what's happening as best as we can and help you identify areas of opportunity. And we'll continue to do so in the days and weeks and months to come. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night, folks.